Hey everybody, it is John Lone King. It is Friday, the 15th of May. The Ides of May are here. If you are a Julius Caesar fan, you know that it's really the Ides of March, but it is the middle of May, and we've got a lot of news this week, a lot of things that are driving the market, and I want to make sure I cover all of that with you and give you all of the information you need to succeed. If you are a home buyer, a home seller, a home owner, if you're a renter, if you're in any circumstance, I've got news for you that you need to know. So here we go with our market update. Here's the bad news, ripping off the Band-Aid. Rates spiked again this week. So we had a couple of big things that are going on, a lot of big things that are going on, actually. Obviously, we have Iran. And we have the issue that's going on with Iran is causing oil prices to go up. And oil prices have continued to be inflated. The hope was it was going to be short term. That this whole issue with Iran was going to calm down faster. And the markets actually had a lot of hope that President Trump's trip to China over the last couple of days was going to create some progress, that was going to have China helping because they're friends with Iran. And so the hope was China was going to jump in and say, hey, guys, let's back off. Let's do what's right for everybody in the schoolyard and not keep fighting in the corner over here because you're impacting the rest of us. But China didn't jump on board. There wasn't much progress made, and the markets reacted very negatively to that this morning. Rates moved up this morning a fair amount, and it is not looking good for the near-term future. So let me give you a better idea of what's happening. We've got inflation pressure that's back, and it's not just a little bit back. Like inflation this week was reported at 3.8%. Now, at the height of the 2022 skyrocket of inflation, we went all the way up to like 9% inflation, but that was really short. We went up and then we came right back down. But the truth is that inflation has been decreasing over the last couple of years. It's where in 2024, late 2024, all through 2025, we saw inflation creeping down. That's where we saw the Fed start lowering interest rates in the end of 2024. They lowered interest rates again in 2025. We were counting on them continuing to lower interest rates in 2026. And then we were counting on the fact that we were going to have the Fed bringing even better rates because they were getting a new chairperson. And today is the day that Kevin Warsh becomes the chairman of the Federal Reserve. Jerome Powell is now sitting in a passenger seat. He didn't leave. He's just sitting there in the passenger seat, and that's creating some major chaos within the Fed. So the Fed has a big problem going on right now that is about long-term inflation. And the outlook for rates this year are not that the Fed's going to drop them. Like we've been talking statistically, what are the chances of rate drops and how many rate drops are we predicting in 2026? We're to the point where the market's predicting rate bumps in 2026. Yeah, the market's predicting rate bumps in 2026. And remember, the market does not move. Mortgage rates don't move when the Fed makes a decision. The mortgage rates are moving today because we're expecting the Fed to raise rates before the end of the year. Now, who knows if it's going to happen, but the market expectation, because inflation is becoming a bigger problem, and therefore lower interest rates are going to have to wait. And that's the challenge that we're dealing with. We came into 2026 with rose-colored glasses. We had the expectation that rates were coming down, that all the stars were lined up in our favor. And unfortunately, this issue with Iran that was supposed to be in and out real quick has drug on. We're now going on 3 months of this issue in Iran, and there is no solution coming soon. But more important, even when the Strait of Hormuz is opened up, you've got to get oil rigs back online because they had to shut down. They have nowhere to deliver their oil because the pipeline, the ships taking the oil, the ships aren't moving. And so you've got all of that has been shut down. It's going to take time for it to get back up and running. And then it's going to take time for the oil to make its way through the system. And in the meantime, we're going to see oil prices continue to be inflated and potentially go higher. But more importantly, the cost of oil trickles to everything else. No matter what it is, I don't care if they're organic vegetables that are grown in the middle of the most pristine garden anywhere, you still got to pay to ship them to wherever you're going to consume them. And that cost increases because of the increase in the cost of oil. Oil permeates our economy. And it's critical to understand that those costs are going up and that it takes a while, even once oil starts producing again, it takes a while for that bubble to make it through to the other side. So we're not seeing short-term inflation. We're seeing some inflation that's going to stick around for a little while. This is not good news. And this is all assuming that we can resolve the issue in Iran quickly. Because if the longer it takes to resolve, the bigger the issue is going to be with inflation, the higher we're going to see interest rates go, the more likely we see the Fed increasing interest rates, not decreasing them. Because the Fed is very worried about the issue they had in 2022, where they thought inflation was transitory. They thought inflation was just a shortage in chips. As soon as that chip shortage block the issues with getting chips created and sent due to COVID is resolved, prices will come back down. That didn't happen. So therefore, we've learned a lesson very recently, and you've got a new chairman of the Federal Reserve that is kind of stuck between a rock and a hard place because he's promised the president. No, he didn't promise the president. Sure he did. He promised the president he's going to lower interest rates. And now he's got pressure politically, he's got pressure economically, and he's got a very, very important job. And we're going to see where this goes. So here's the deal. It's now all about monthly payments. It's now all about how is this going to impact your monthly payment. I don't care whether you're buying a home, selling a home, or refinancing a home. Ultimately, everything revolves around monthly payments. When you qualify to buy a house, you don't qualify for a purchase price. You qualify for a monthly payment, which means a lender who told you a month ago that you're qualified for a $550,000 home, maybe today it's only $500,000. Now, maybe it's not that dramatic, but it could be because you're qualified for a payment, and unless your income changes or your debt, or debt. So if your income goes up or your debt goes down, other than that, you're looking at not qualifying for a purchase price, but qualifying for a total monthly payment. And that payment assumes an interest rate. It assumes a certain amount of money you're paying for property taxes and homeowners insurance. Those assumptions, when they change, can change your buying power. I had a client today ask me, John, I really don't understand. I'm thinking about single family homes versus townhomes, and everybody says I qualify for this price. Oh, but wait, you're buying a townhome, it's going to be at this price instead. I don't get why they lower the price. And I explained because the payment's what you're qualified for. And when you add an HOA, you have to lower the price. So the total payment with the HOA is within that tolerance. So that's the key, is you qualify for a monthly payment. You don't qualify for a purchase price. And so higher rates can change your buying power. But here's the deal. It's not just about buying power, because sellers are feeling it too. You're going to have some sellers that aren't going to sell because most sellers are buyers. Most sellers need to buy another home, and they're not going to sell their home if they can't reliably predict what their payment is going to be once they buy the next one. Think about that. So therefore, there can be less inventory coming on the market, and you've got sellers who don't care about that piece, but they really do need to sell, that are realizing, hey, these higher prices are going to scare off some buyers. Maybe I need to give some more incentives. Maybe I need to find a way to get this buyer to find my home more appealing than the other ones by giving some closing cost credits, by helping them buy down their interest rate. So I think we're going to see a lot of those things. And I'll tell you that those of you who are homeowners that are thinking, man, maybe I should refinance, here's the problem. You never know. The problem with refinancing is you never know when the right time is to refinance. Because unlike when you bought your home, like you found the house, you got an offer accepted, you have 30 days to close, which gives you like 2 weeks at most to lock that rate. But on a refinance, you can say, well, rates have been climbing, and so maybe I'll wait until they drop back again, but maybe it takes 2 years for them to drop back again. Think of all the people when rates started going up in 2022 that said, you know what? Rates have gone up and they're now at 3.75. They were at 2.75. I'm going to wait until they come back down to 2.75. You're still waiting. Then rates went to 4 and 4.25 and 4.5. And they're like, no, I'll wait until they come back to 3.75. Then they go to 4.75 to 5 to 5.25. And say, okay, fine. I'll wait until they come back to 4.5. We all know how this story ends. It hasn't come back down. So if you can save money, if the numbers make sense, you should do it. You shouldn't wait to say, no, I got to have a target number. The rate is all that matters, John. Stop trying to convince me otherwise. Maybe. But think about the rate you're paying on that 22 to 29% credit card. Think about your home equity line of credit that's at 12% interest rate. Those rates matter too. So you've got to think about it holistically, and you've got to have somebody that you trust to help guide you through that process. And I'm interviewing for the job of being that person. All right, a couple other things. Income, area median income. So every year in May, actually in April, HUD, the Department of Housing and Urban Development, publishes the area median income numbers. This year it got delayed by a month. And so they publish it on May 1st. That trickles down. Fannie Mae and Freddie Mac publish AMI numbers. Then people like Cal HFA, who does down payment assistance programs, they publish their version of the numbers. Why does this matter? Because a lot of down payment assistance programs are based upon how much you make compared to the average income, median income of the county that you are buying in. That matters for people who are looking to get into particular programs. By the way, there are programs that don't care about your amount of income. So if you're saying I'm not going to move forward because I don't make under those thresholds, there are other programs out there. You're talking to the wrong loan officer. But there are some really good deals if you're under certain thresholds. Those thresholds are changing. Now, I ran the numbers in using HUD's numbers. In California, 15 counties had income average, the median income, go down. That means that in those 15 counties, there's a really good chance that if you're waiting for Dream for All and you've got an income that is just barely below the limit, that limit could drop. And if it does, you no longer qualify, even if you have a voucher. Now, the other 78 counties, the income limits went up. So the majority of counties in California, the income limits are going up. But I'll tell you something else. I don't understand this math. I haven't ever taken the time to dive into it because I've seen HUD's numbers where one county from year over year goes up, and then CalHFA's numbers, they stay the same. So I'm not telling you that 78 out of 90 plus counties are going to go up. I'm telling you that statistically, the majority of them are higher. That's good news because more people will fit in under the limits. But some counties are dropping. So that could be bad news for those counties. So I just want you to be aware of how the math works because this all plays down to affordability. And when we're looking at affordability, it comes down to your math because there's two numbers that I look at. The payment I will let you spend and the payment you're willing to spend. This is the affordability piece. I don't know what you spend on Starbucks. I don't know what you spend on going to Disneyland. I don't care. You're going to talk to some people who are going to say, oh my gosh, how dare you go to Starbucks? If that's what you want to do, do it. I don't care. It's just everything in life is a choice. And so it's about you choosing where your priorities are. And I'm not here to help you be your ethical guide to say, or your financial guide to say which direction you should go or not. What I'm here to do is to define your choices for you. And it's really about affordability, and you need to know your numbers. And so if you haven't figured out your numbers, you need to talk to me. So I want you to scan this QR code up here, click on the link, get a hold of me and schedule an appointment with myself and my team. We are looking forward to taking great care of you. You've heard me say it before. I'm interviewing for the job of being your lender. Whether you're purchasing a home, refinancing a home, moving up to a bigger home, or downsizing, I am here to help you make your home ownership dreams come true. And I'm looking forward to guiding you through that process. So thanks everybody for listening. Have an absolutely glorious weekend, and we'll talk to y'all soon. Bye-bye.